Hello, everyone, and thank you for joining us today. We're going to talk today about the Secure Act 2.0, particularly about some of the provisions that impact workers. But a bit of history might be in order. Back in December of 2019, Congress passed the original Secure Act, which provided the largest retirement reform since the Pension Protection Act of 2006. A lot of the more impactful provisions of the original Secure Act impacted retirees because it changed the way it changed the age at which retirees were required to distribute money from the retirement accounts. And as importantly, it also changed the time frame that non-spousal beneficiaries had to distribute money that were held in retirement accounts. Both of those provisions really impacted income tax and estate planning issues for retirees. A lot of the provisions around the current Secure Act really impact workers because this act was passed in December of 2002, and the intention was to expand some of the provisions of the original act. And in our most recent presentation, we talked about those that impacted retirees. So today we're going to talk more about how these provisions in this Secure Act 2.0 impact working individuals. My name is Chris Reid, and I'm the Director of Tax Planning at Blumark Tax Advisors. And over the past 3 decades, I've spent time in different areas of the financial services world, including the mortgage industry, financial planning as an advisor, and then, of course, now in the income tax arena. Since our inception, our focus at Blumark is to provide a more holistic financial and tax experience by combining strategies from both disciplines, and that's for the benefit of our clients. And if you think about it, just about every financial decision that you make has some type of a tax consequences. And I think, what we're talking about today, which is the Secure Act 2.0, there's been other pieces of legislation recently, the Tax Cuts and Jobs Act, the original Secure Act. All those things that are tax issues, they do have a pretty significant impact on our financial situation. So our goal, our objective is to work with our clients to advise on both areas simultaneously. You may hear me say this a lot today, but the devil is always in the details when it comes to tax legislation. One of the things about this particular piece of legislation is it really talks a lot about Roth accounts and how they should be expanded. So, as an example, one of the provisions is where matching contributions and the non-elective contributions, you have a choice on where those funds will go. And we'll talk a little bit more about how that works and how to guide you on that. Catch-up contributions are also going to change. So if you're a high-income earner, you have some limited options. And then as you get a little older, some things change there with some expanded catch-up contribution options. And then lastly, for small employers, for self-employed people, there's some changes to now you're able to contribute to Roth accounts inside of certain types of retirement plans. But again, every situation is a little bit different. And before you just assume that you understand all the details, kind of like we think today, we'll talk a little bit more about some of the specifics, but these things can change, and it always helps to seek a second opinion or to get some additional guidance when you're not 100% sure on how these things are going to impact your situation. I find it instructive to just have a brief conversation just about how your assets and investments are taxed. The IRS looks at all of your investments, and then there's a specific way that each of your investments is taxed. So, for example, we start at the bottom left where you have checking accounts, savings accounts, stocks, mutual funds, etc. ETFs could be part of that. It's where you're putting money into those types of accounts with after-tax dollars. That's just to say that I've already cashed my paycheck and I can go buy a mutual fund, a stock, or I can go put money into a CD or a checking account or whatever. But if that CD pays interest, I'm going to pay taxes on that interest at the end of the year. Same thing if I own stocks or a stock portfolio that pays dividends. I'm going to get a document from the custodian that says that they paid me a certain amount of dividends that year, and I have to report that income on my tax return. The the benefit there is that when you put money into these types of accounts, it's completely liquid. So, but the downside is that, of course, you're going to get a tax bill every year. So it's just a good practice to monitor the amount of money that you have in that particular area, so that you're not getting overly taxed. So the bottom right is where most people do the bulk of their savings, and that's in 401k plans, 403b plans, and oftentimes those funds, when you separate from service, you'll find that there's an opportunity to transfer those funds or those accounts over to traditional IRAs. Not many people contribute to traditional IRAs anymore, but you may have IRAs as a result of separating from service from an employer and then transferring your old retirement plan to an IRA. Nonetheless, it's from a tax standpoint, that's where most of the time people put money in pre-tax. And then what happens is when you invest money pre-tax, your investments or the account itself it's never been taxed. So all of your contributions plus any future growth on those contributions is going to be taxable when you take the money out. So whether it's in a 401k or whatever, it's money that's going to eventually be taxed unless you used what's referred to as a Roth account inside the 401k. But generally speaking, pre-tax is going to be taxable when you retire, when you start distributing funds. Then we look at after-tax and a tax-free type of an investment. So when you put money into a Roth IRA or a 529 plan or other types of investments, you're not getting any tax benefit when you put the money into a Roth, as an example. But your contributions plus all of your growth are going to be tax-free when you take the money out when you need it. And as long as you follow the IRS rules, then Roth IRAs, 529 plans, and others are tax-free when you take the money out. One caveat about a primary residence is you do have an exclusion amount, so it's not always 100% tax-free. So for an individual can have up to $250,000 of gain. As a married couple or a married joint couple, you can exclude up to $500,000 of gain on your primary residence. And that's as long as you lived in the home at least 2 of the most recent 5 years. Now, the top left box is fairly straightforward. If I go buy a second home for $200,000 as an example, and let's just assume that I don't put any money into it, no improvements or whatever, and I sell it for $400,000 later on, I pay taxes on the difference between the $200,000 and the $400,000. And that's treated as a capital gains tax. Other types of investments there that are considered to be, that you don't pay taxes on while you own them are, if you go buy vacant land, that's one. Variable, it could be a variable or a fixed annuity, or what they call a tax deferred annuity. That's kind of an old school retirement plan. You're not going to get a tax bill every year, so it's going to grow tax deferred, but you're going to have to pay taxes on it when you start taking money out. Similarly, you'd have to do the same thing with an after-tax IRA, which again, not a very common strategy, but there are those that have money in after-tax IRAs. I said a minute ago that there are a lot of Roth provisions inside of this particular piece of legislation. So I look at it, maybe they should have called it Roth 2.0 instead of Secure Act 2.0 because of some of those provisions. And an example of that is the first thing that we're going to talk about, which is how a participant in a retirement plan has really 3 choices on how to treat their matching contributions. So historically, if an employer matched on the retirement plan, you didn't have any choice. You just get the match, and it just gets added to your account. Now the choices are do nothing, and then have it be effectively just be considered pre-tax. So a matching contribution just goes into your account. The employer gets the tax benefit, but that matching contribution plus growth on the matching contribution grows tax deferred, but then you're going to pay taxes when you take it out. Then now there's these 2 other options, which the first of which is that you can designate that matching contribution to go to a Roth account. So in that scenario, again, just like we talked about other types of Roth accounts, those matching contributions, they'll be taxable to the employee when they make that election, but then that money will never be taxed again because it's going to grow tax free and it's going to be taken out tax free. The other option, it's for newer workers. They don't have to necessarily be newer, but if a worker has student loan debt, then the Secure Act 2.0 allows for the matching contributions or other what's referred to as non-elective contributions to be sent to pay down student loan debt. So again, I don't. We're looking for guidance on how those things will be tracked, because you're talking about changes to W-2s if a matching contribution goes to a Roth account, because it's going to be treated as compensation. But then also the complexities of tracking down how you know that someone took matching contributions and made student loan payments with it. Those are things that we're still waiting to get our arms around. But nonetheless, those are different provisions of the Secure Act 2.0 that we need to take into account. One of the significant changes takes effect in 2024, and that has to do with catch-up contributions. So back in 2001, that's when the first legislation passed that allowed workers over the age of 50 to contribute more to retirement plans. And of course, it was aptly named catch-up contributions, because if you're over the age of 50 and you haven't done quite as much saving into retirement as maybe you should have, they said, now it's time to catch up. So we're going to call those catch-up contributions. And so that's been quite a while. It's been 22 years ago. So the changes that were prompted by Secure Act 2.0 are that now if you have income over $145,000 in the preceding year, then your catch-up contribution is required to go to the Roth account. Now, there's a couple different caveats here. So it's simply, it's not as simple as saying that if I have income over 145,000, I automatically have to use the Roth account. It's just not that simple, because the verbiage in the bill actually says that wages for the preceding calendar year from the employer sponsoring the plan exceed $145,000, and then it goes on to talk about other things. What that's saying is that if you are the only way that the $145,000 matters is if you're working for the same employer, because it has to be the employer sponsoring the plan. So if you change jobs, it doesn't really apply. If your income with the employer is less than $145,000, then you still should be able to contribute pre-tax. The other area that it doesn't really address is for self-employed folks. So if you're self-employed and you're filing your taxes on, or you're filing your income, reporting your income on a Schedule C, or that would be the big one, is you have self-employment income. You don't have wages, but it's, you pay taxes on all of your income. You pay self-employment taxes on all of your income, but it's not considered wages. So there's appears to be an exemption there for those that are self-employed, even if their income is over $145,000. Then the other issue is what happens if the employer doesn't have a Roth option in their plan? So if you work for an employer and your earnings are over 145,000 with that employer, and the employer doesn't have a Roth option, what are you supposed to do? And the answer is pretty straightforward. If there's no Roth account available, then there's no ability to make a catch-up contribution regardless of what your prior year's wages are. So there's a little bit of nuance there, and I think it's, again, the devil is in the details. And if your income is over 145,000, or if there's reasons to have concerns about that, then you should talk to someone and make sure that obviously we're doing the right thing there. So let's fast forward to changes that take place in 2025. So the big one is that the catch-up amount, or the catch-up contribution amount that we've just talked about, is going to increase if you are age 60, 61, 62, or 63. So if you're between ages 60 and 63, the expanded catch-up contribution is going to be $10,000. So how they arrived at just having it for 4 years, I don't know, but that's essentially how it works. And then, it does beg the question on, what happens if you're 64? And the answer is I don't think it matters. You're going to go back to the regular catch-up contribution when you're 64. So unless there's other guidance that we get between now and the end of the year, that's what you should expect, is that if you're between ages 60 and 63, you're going to only be able to contribute this. That's the only ages at which you'd be able to contribute the additional $10,000. And there are some other rules around that. Catch-up contributions themselves are indexed for inflation, so there's a provision that the catch-up contribution limit is either the greater of $10,000 or 150% of the regular catch-up contribution, and again, that's indexed from inflation. So just know that you're going to get information from your employer that tells you really how much that catch-up contribution will be. And then, of course, if you work with us, then we'll educate you and make sure that you know how much you can contribute to retirement plans. The last thing we're going to talk about today is some of the retirement plans that are available for self-employed people. And there are two in particular. There is the Simple IRA, and then there is what's referred to as a SEP IRA. Both of those are acronyms, and one stands for a Savings and Investment Match Plan for Employees, and the other is a Simplified Employee Pension. But they're both acronyms, and they both, historically, you've only been able to make pre-tax contributions to those plans. And now you have the ability with this legislation to contribute to the Roth option inside, or there's a creation of a Roth option for each of these types of retirement plans. So again, the Secure Act 2.0 does a lot in the way of allowing for additional contributions to Roth. And again, I think the biggest thing when we start looking at whether to use the Roth account or pre-tax account, it largely depends on timing, because we have to overlay what's happening with all of these financial decisions with where you're at from an income tax bracket today and where we think you'll be at in retirement. So the Roth may be a better option now. In a few years, it may not be a better option after tax rates change. So, and again, that's all part of a discussion around the Tax Cuts and Jobs Act, which we went fairly in depth the last webinar. But again, a lot of different changes that we just need to be aware of, and the changes in these types of retirement plans is just an example of that. The heading on this slide says IRS issues, but I would say that even more, we're looking at those that are affected by these changes. The IRS has to make changes, or has to decide on how they want the W-2 to reflect the employee's choice and how they take the matching contribution. That's kind of an unusual problem to solve, but I'm sure they'll figure it out. The other issues, and again, some of these affect the plan custodians, they certainly affect the participants, the employers, et cetera, but not all plans currently offer Roth accounts. So, how do we deal with that? The other issues, even if they have all of the bells and whistles in their current retirement plan, now you throw these other provisions in there regarding the catch-up contributions and how matches are going to be allocated. The employers have to make changes to plan documents. That's to accommodate matching contributions, pre-tax, post-tax, catch-up contributions going to Roth accounts, added catch-ups for age 60 to 63. It's just, there's a lot of different changes that these companies have to make. So you won't see them all happen, right away, because it takes quite a while to get those provisions changed and to make the changes really just to even the basic paperwork. And again, the one around, how student loan debt is tracked. If a participant's using the matching contributions to make student loan debt payments, we have to figure that out as well. So there's a pretty significant number of things that we have to figure out and we need future guidance on. But regardless, this is what we're dealt with. And if you think any of these things are going to impact you, obviously you'd want to reach out to someone to have that discussion. And of course, our team is here and available to help you with any of these items. So if you have questions around any of the provisions in this particular legislation, or you want to get an overview of the Tax Cuts and Jobs Act, or any other issues that you feel that you need to address, we're going to welcome the opportunity to meet with you and address any concerns or any issues that you have. There are a few different ways to reach us. You can use our website at blumarktax.com, and there's a way to get more information there. You can also send us an email at info@blumarktax.com, or just give us a call at 248-289-1647, and we'd be happy to talk to you. Lastly, feel free to connect with us on Facebook or LinkedIn. In the meantime, have a great day, and thanks again for joining us.